Hey taxpayers, my most recent full-length video discussed the topic of the ultra-rich potentially paying very little to no income taxes. Now, to summarize that video, when we talk about the ultra-rich, we're usually talking about the ultra-wealthy because they have a lot of wealth. That makes sense. And whenever we're talking about income taxes, we're talking about a tax on income. Okay, that also makes sense. But here's the thing, wealth and income are not the same thing. And because of that, you can quite literally be a multi-billionaire. But as long as your wealth, or at least the incremental increases in your wealth, isn't attributed to income, then there's nothing that's going to be subject to income tax. So if you're someone that wants to tax the rich, or you see charts like this and it makes your blood boil, well, the answer isn't so much closing tax loopholes or putting them in jail because they're doing tax evasion. No, the underlying issue is because wealth just isn't taxed. So if we want to tax the rich, we need to implement a wealth tax. Now, whether a wealth tax is a supplement to an income tax or it's substituting it, that's a completely different story. But spoiler alert, you can probably tell from the title and length of this video, a wealth tax is not going to be simple. And I would go as far as saying that a wealth tax would be substantially more complicated than our current income tax system. Well, let's just jump into it because there's a lot to cover. I'm sure I'm not even going to be able to cover everything, but if you have any different opinions, I'd love to hear them. That's how we learn. So again, love to hear your opinion if you think of anything different. First and foremost, we have to define wealth because you see, wealth in itself is a pretty generic term. My definition of wealth may be different from someone else's. And the problem is whenever we talk about wealth, especially even in today's, political, news outlets, the way that some people may present wealth is also different. So news article A can present wealth one way, while news article B does it another. So there's already a mismatch as to what wealth actually is. Now, generally speaking, whenever we talk about wealth, we're usually talking about net worth. Again, from that prior video, we learned that net worth is just the letters O, E, and ALO. Again, ALO is assets equal liabilities plus owner's equity. And if you've ever taken an accounting course, I apologize for the PTSD. But we can take this concept of ALO and make it even simpler so we can all understand. Again, assets are just things that we have, liabilities are obligations we owe, and everything left over is what we own. It's our ownership stake. Now, some proponents of a wealth tax discuss potentially taking the concept of a property tax and expanding it. Now, whether that expansion is just consolidated in our local governments or if the federal government comes in, takes their slice, again, completely separate topic. But here's the biggest problem between a wealth tax and a property tax. Property taxes don't care what you own. They only care about what you have. To illustrate this, let's take two houses. Now, these houses are neighbors. They're on the same street. They're side by side. And that's a great comparison because that way we know that in our current property tax system, the governing body, whether it's the municipality, the local county, whatever, they're going to assess these two houses the same way. So not only is this an apples to apples comparison, this is a Granny Smith to Granny Smith. So we know the comparison of these values in these two houses are going to be, again, very comparable, obviously. Now let's say that both of these houses have a value of $250,000, $250,000. But the people or person who lives in house A owes nothing on it. They own the house outright. So again, if we plug that into ALO, we see that $250,000 is not only the asset value, but it's also the equity value. That's what they own. Now, on the contrary, the people who live in house B actually have an outstanding mortgage of $180,000. Again, we plug that into ALO, and that shows that they have an ownership equity of $70,000 in this case. Again, property taxes would look at this and say, okay, both house A and house B would have the same property tax. Because again, property taxes don't care what you own, they only care about what you have. But wealth tax, on the other hand, cares about our own number. Because again, that's what usually wealth means from a net worth perspective. So if we're going to look at this from a wealth tax perspective, we can see the people who live in house A, again, just looking at the house, is more than 4 times as wealthy in terms of the people who live in house B. But let's think about this in realistic terms, especially in the next 10 to 20 years. Who is going to live in houses that are paid off? It's going to be older people, right? The ones that lived in the house long enough where they've paid off the 15, 30-year mortgages or whatever. They're usually going to be the ones that are having houses that are paid off. So in this case, the people who live in house A may be a widowed grandmother. And as a side note, kudos if you know where this grandmother's from. Which also means that if we look at house B, maybe that could be a newly wedded couple. Maybe they just had a kid. Maybe they just graduated college. Who knows? Now, if we take these numbers in context of a wealth tax, we can see that grandma has more than 4 times as much wealth. Again, we're just looking at the house here. than, again, the people who live in house B. But again, wealth and income are not the same thing. So grandmother in this instance, again, maybe she's widowed, maybe the grandpa, when he passed, all he left behind was a broken heart. So again, maybe she doesn't have much. Maybe she's on a fixed income. So again, maybe her total annual income is like $30,000. But the people in house B, maybe they just graduated college, hopefully maybe trade school. You usually earn more that way. And maybe they're bringing in $200,000. So quite literally, from this perspective, the people in house B may have a much larger income than grandma in house A, but grandma has a larger wealth value. And I'm not claiming to be a real estate mogul, but if house prices continue to climb the way that they are, people who are older that live in paid off houses, they can't afford to move. They're essentially stuck there. And obviously, once we get hit with tax, whether it's income tax or wealth tax or whatever, we have to pay it in cash. And again, we usually can't just liquidate wealth right away. I'll get into that here in a little bit. So grandmother in this instance may actually be worse off. It's probably going to be very burdensome for them. Now you might be saying, Trey, this is a stupid example. We're not talking about kicking our sweet old grandmothers out of the house. We're talking about taxing the ultra millionaires and billionaires out there, not sweet old grandma. Okay, fair point. And actually leads into a nice segue into the next issue. The next issue we're going to come across is how exactly do we value wealth? Going back to this housing example, again, in this instance, the houses were valued at $250,000, $250,000. And again, granted, that would be coming from the tax authority or again, local government, municipality or whatever. But if we think about it, have you ever noticed that the value of your house is never the same as what your insurance person is going to tell you, which is also going to be different than what a realtor may appraise it at, which is also going to be different than what Zillow, which again isn't really based in reality, that Zillow is going to say. And ultimately, the biggest probably determining of a value is what the intersection is between a willing buyer and a willing seller are willing to meet at. Again, these are all different numbers, valuations for the same asset in this case. So let's ignore the housing example. Let's ignore poor old grandma, and let's get back to reality. Because again, let's talk about the ultra, the millionaires and billionaires and whatnot. And let's talk about things that actually have some sort of valuation issue. Now, when I originally was recording this, I was talking about the concept of art, and I realized quickly that this was actually going to be a whole huge rabbit hole. This could be an easily 10, 20-minute conversation, and I actually just completely scrapped it. So if this video gets any sort of traction or any type of interest in this type of topic, I would love to talk about more because, like I said, once you start talking about the valuation of art and how it applies to like taxes and wealth and all that, again, huge rabbit hole. So again, probably a separate video. So let's talk about something else that produces a lot of wealth for, again, the ultra wealthy. Let's do collectibles. Now, this base is extremely valuable. It was actually the same base that's been used in the Scott Pilgrim movie. And even Michael Cera even signed it for me. If you don't believe me, here, take a look. That's not AI. Here's the issue when it comes to valuation. These bases usually run for a couple grand brand new, but this is about umpteen years old, and Michael Cera took about a 50-cent pen and marked on it. So what does that do to the value? Does it go from 2,000 down to 1,000 because it's been used? But how do we evaluate the price or the appreciation when someone signs something? Well, let's look no further than the people at Pawn Stars because this will kind of highlight the point. If you've never seen Pawn Stars, let me kind of just break it down in a quick, line by line exchange. Someone's going to bring something in. They're going to want to pawn it or sell it. They're going to get the workers at the pawn shop. They're going to look at it. They're going to tell you some history behind it. They are going to bring in an expert because again, they got to fill in the time slot. An expert comes in, gives even more information on it, and gives a valuation as to what that appraiser thinks it is. That amount is going to be, again, what they think they can go for auction. And at that point, the negotiation happens. And usually you'd be lucky if you can get like half of what the appraised value is. But see, therein lies the issue. We got a appraised value from an expert, but ultimately, usually the most agreed upon way to value an item is what a willing buyer and a willing seller are willing to meet at. So in this case, if someone looks at this base and says, wow, Trey, this could fetch $1 million in auction. And I take it to a pawn store and they look at it and they're like, I'll give you $3,000. And I accept it. Ultimately, we can argue that $3,000 was the actual worth. But more realistically, if you watch the show, again, if something gets praised at $1 million, the person who's trying to pawn it or whatever is probably going to want like maybe 80 or 800,000 in this case. The owners of the pawn shop are going to kind of rebuttal and say, oh no, it's going to be 500,000. And if you watch the show, sometimes Rick, again, the owner of the pawn store or pawn shop, will usually say something to the effect of, well, I'm taking on the risk and I've got to pay, blah, 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 and these people. And again, if we take that into consideration, it's even more arbitrary as to how this is valued. Because in this case, the base may not actually be worth $1 million. If we could fetch it for $1 million, but portion of that is going to have to go to appraisers and auctioneers and what other overhead. So in that case, that's up and beyond the value of the actual asset. So if the gross appraised value from an auctioneer includes some sort of monetary value for things like the auctioneer or bidding commissions or whatever, then that takes away from the actual asset. And if we're going to have more hands in the pot, then there's going to be a more inherent risk of collusion. So for example, Wata Games and Heritage Auctions. If you don't know anything about them, one of them was a video game grader, the other is the auction house. There was some collusion going on that actually ended up inflating the price of used video games to the point where people thought it was price speculation. In the end, I don't know the whole outcome of the case, so I probably shouldn't have brought it up. But again, a lot of people thought that those two were working in tandem with one another to, again, artificially inflate prices on used video games. Again, AA collectibles. But again, it highlights the fact that, again, once you start getting multiple parties involved into the valuation process, possible collusion and price manipulation. Let's talk about another valuable asset that rich people have that boosts their wealth. What about the value of companies? Sort of the same situation that we saw with the Pawn Stars example. But let's take Shark Tank and Dragon's Den, for example. If you've ever seen the show, hopeful entrepreneurs come in, they have a business valuation as to what they think their business is worth. They go in front of a panel of 5 sharks who then potentially can, again, buy into the company. But right off the bat, we can have one valuation for a person who's actually the entrepreneur, and the 5 sharks could have actually 5 different valuations on that same business, which leads to the question, which of these potential valuations is actually accurate? It's kind of like the Supreme Court parable, where you can walk into a court of 9 professional judges and present the case. Again, the same case, all 9 of them are going to see the exact same facts and circumstances and whatnot, and you could potentially get 9 different answers. And that same situation happens with valuations. Again, same facts and circumstances given to different people, whether they're sharks or appraisers or whatever, and you can get different valuations for each one. And that begs the question, ultimately, which one is the accurate one? Ultimately, the biggest issue when it comes to figuring out the valuation of your wealth is how exactly do we value the asset portion of that equation? Because again, going back to Allo, owner's equity is a function of assets and liabilities. Liabilities is extremely easy to identify and calculate. Again, just call up your lenders. If you have a house, call up your lender. If you've got a credit card debt, call up your credit card companies. They'll be more than happy to tell you how much you owe down to the penny. So the liability function of an Allo is extremely simple, but the asset valuation, again, quite literally can be arbitrary. And just to highlight something I mentioned a little bit earlier, usually the best way to value anything is, again, the intersection of what a willing buyer and a willing seller are willing to meet at. Because again, if I go on eBay and I list this roll of painter's tape for $50, well, I'm willing to sell it for $50, but you as a buyer aren't willing to pay it. Maybe you're only wanting to pay $1. And let's just say that we've haggled and we eventually met on $3. So what was the ultimate price, the ultimate value of this roll of tape? $3, right? Because ultimately that was the value to transfer it from one hand to the other. But going back to the value of people who are, again, wealthy, things like collectibles and antiques and so forth, how do we actually calculate that intersection of willing sellers and willing buyers? Because again, I'm not willing to sell this. So in this case, there may be willing buying numbers, again, which may be influenced by appraised values and eBay listings and whatnot. But if I'm not willing to sell it, that's half of the equation missing that actually ultimately determines what the true value even is. Now, at this point in the video, I was going to talk about how arbitrary valuations play into the stock market. Again, I'm not a Wall Street guy. I'm not a stock expert by any means. So I just kind of cut that part out because, again, I really don't know what I'm talking about. I was just going to sound like a Neanderthal. So. But just to kind of highlight that, when we talk about stock prices, there is going to be some estimate when it comes to valuation. Now, there is some rooted in reality, right? Because the value of Netflix stock is going to be substantially higher than Blockbuster stock. I think we all can agree on that. But even at the time of me recording this, the value of Netflix stock has fluctuated. Now, granted, obviously it's going to be contributed to shares outstanding and any news about the company that's going on. But how do we know that the value of the stock that's being traded, again, at the timing of whenever you're seeing this, is the actual true value? Okay, so I think we all can agree that there's going to be some issues with valuation. So let's just jump on to the next issue, which probably is the biggest issue. And I'm actually going to put it in red text here. And that is, when do we value that wealth? Now remember, wealth is a value of ALO. Again, we're just going to assume that OE, owner's equity, is what we're going to consider wealth. Now we talked about earlier that wealth and income are not the same thing. We all know what income is. And income is a function of revenues and expenses. Or if we're talking specifically taxes, it's income less deductions, same thing. But when it comes to reporting from an accounting standpoint, ALO is at a point in time because ALO represents balance sheet. And again, a balance sheet is reported as of a specific day, again, a point in time. But revenue and expenses are reported on an income statement, and income statements are reported on a time basis of a period ending. So again, period ending for a week or a month or a quarter or a year. It's a span of time. So you can think of it as a balance sheet. Again, wealth in this case is a picture, whereas income, or again, income statement, is going to be based on like a picture. To kind of highlight this, let's look at this missing dollar riddle that you've probably seen floating around at one point. It says, math riddle, where did the extra dollar come from? Let's say I have, spoiler alert, where have we seen the word have before? All right, back to the riddle. Let's say I have $50. I spend 20, 15, 9, 6, and of course you can just quickly look and see that they added up everything that's in the spend column, and then the running balance, which makes sense. If you started with 50 and you spend 20, you have a balance of 30. If you have a balance of 30 and you spend 15, you have a balance of 15, and so forth. However, they summed up both columns. The spend column comes out to $50, but the balance column comes out to $51. Now, if you don't know the answer to the riddle, I'll explain it here in a minute. But if you already do know the answer, then great, because you know that there is a difference between the income and the asset valuation when it comes to time. Again, in this case, spend is an expense. It's an income statement account. Remember, income statement accounts are reported on a time basis as of a specific period, whether that period was over the course of a week or a month or a day, whatever. But balance is at a point in time. You don't add it up accumulatively. It's, again, at a point in time. So whether the spending of $50 was over the course of a day or a week or a month, it doesn't matter. Because spend is, again, an expense. It's an income statement account. So we're going to add it up over the course of the time of this spending of $50. Again, let's just say it's a week. So again, if you spend 20, then you spend 15, you spend 9, you spend 6, add up all together, and you spent all $50. But if we look at the balance column, again, this is an asset. Remember, let's say I have, remember when I said where we've seen the word have before, have is an asset. Asset is a balance sheet item. And balance sheet items are reported on a as of date, like at a point in time. So in this case, it wouldn't make any sense to add up the balance column. If you started with $50 and then you had 30, you don't add them up together. Just like you don't add up the 30 and the 15. You don't add up the 15 and the 6. Again, it doesn't make any sense at all. And to take another step further, let's say we have the same riddle, but instead of us spending this arbitrary amount, let's just say we spend $1 at a time. We go to a dollar store and we just spend $1 every day. In this case, we see that the spend dollar or the spend column would be 1 plus 1 plus 1 plus 1. Repeat that 50 times, and that's $50. But our balance is going to be 50, 49, 48, 47, and so forth. Can we see that you wouldn't add up 49 and 48, 47, 46 together? That doesn't make any sense. So let's say we're trying to look at it from a tax year perspective. Tax year 2025. You have $100 of revenue or income in January, and you have $300 of income or revenue in February. If we wanted to look at what we had in terms of income for, again, 2025, we would add January and February together. In this case, $400. But if we take that same numbers, that same story, but substitute income for wealth or assets, in this case, it doesn't make any sense. So for example, on January, you had $100. In February, you had $300. Does that mean that we had $400 in total? No. You end with whatever the last number is, because again, it's at a point in time. So if you have, again, $200 in your checking account at the end of February, then we're not going to add up anything else that happened prior to that, because again, everything has changed and accumulated up until that point in time. And that leads to the heart of the issue. When are we going to assess the tax on wealth? Because again, if it was income, we just accumulate it for the whole year. You made X amount of dollars in January and, added up all the way through December. Add it up together, there you go. There's your income. But wealth is not that way. It changes over time, so you usually have to stop it at one point, and that's the value that you're going to assess the tax on. Now, we could say December 31st because that just makes the most sense. It's year end, it's the end of the year, and that way we kind of close out that year for whatever the value of your wealth is, and that is going to be what's assessed for taxes. But that kind of piggybacks off the prior issue when it comes to the valuation of assets. Now we got the valuation issue on top of the timing issue. So again, if we try to do something like, again, whatever your value is worth at the end of the year, that's when you're going to be assessed tax on. But let's say, for example, I have a collectible on, again, maybe December 30th. Now, this is an extremely rare card. There's only 3 in existence. So that's going to give me a whole bunch of wealth, and whoever has the other 2 will have a whole bunch of wealth. But let's just say, hypothetically, I destroy it. I deface it. It's ripped. It's destroyed. Well, the value of that asset for me has just decreased. My wealth has just plummeted, again, on this date of, whatever I say, December 30th, and arbitrarily, the value of the other 2 has just increased. I just increased the tax liability of 2 people who I don't even know. Whoever holds those other 2 cards, again, they're going to have to pay more tax. But who's going to be able to substantiate the value of that asset, again, at the end of the year, whether this was still intact or not, and whatever was still outstanding, in this case, the other 2 cards, what value are those going to be getting? Because again, now those are the only 2 ones that are outstanding that are in good condition. And kind of going back to what I talked about earlier when it comes to collusion and just other hands in the pot, if we are trying to value assets at a specific point in time, who's to say that there's going to be, again, even more arbitration, even more collusion when it comes to those price values? So for example, if the value of this vase, again, very collectible, is $20,000 throughout the year, but let's just say in December, the appraisers just come out and say, Trey, no one wants red Rickenbacker vases anymore. They're ugly, they sound like crap, and nobody wants them anymore. So you can only get this, you can't even sell this anymore for $100. So I mean, the value of this just tanked. In that case, we can completely manipulate the prices at the end of the year in order to, again, pay less taxes. And once January 1st rolls around, oh, never mind. Everyone loves Rickenbackers. Price skyrockets. Now, obviously, to combat this, one thing we could do is issue a tax on the average value throughout the year. So again, not so much as a point in time, but average. In order to average, you have to have 2 points in time, whether it's the beginning of the year and the end of the year, which makes the most sense. But again, once you have an average, there has to be 2 points in order to find an average. But sadly, not all averages, even though they are the same, are the same. So for example, here's a little chart I just threw together. Again, just taking 2 arbitrary numbers between someone who has, person A versus person B's wealth. And they have the same average throughout the year, which again, we'll just do January 1st or December 31st. Again, makes the most sense. But when we ask the question, who's more likely to pay tax? The answer more than likely should be A, right? Because in this case, person B in this case, their wealth is tanking. They're probably on the verge of bankruptcy. And taking it a step further, keep in mind whenever we're talking about the assessment and the payment of tax, there is a delay. So not only is this the wealth value between, again, January through December, which again, that'll give us a value of wealth, but once we extend it into the tax season, like this chart shows, again, what's the wealth going to be for the first part of the year? Because if it's continuing to go up, it's going to make the ability to pay tax for the prior year easier. Unlike, again, if person B's, in this case, if their wealth is tanking and once January hits, it's plummeting even faster, more than likely that tax assessment on that wealth for that prior year may be uncollectible. Now again, just comparing this chart to income, because remember, whenever you have income, there is something that is being recognized, and usually you set parts of it aside in order to pay the tax for that next spring. But wealth is just not that simple, because again, you have to liquidate it in somehow. So if all of your wealth is being depleted over time, you're taking an average, which means you had more wealth valued at one point that you no longer have. And then once the end of the year happens, you have even less. But once it comes time to actually pay the tax, you have even far less to liquidate in order to pay tax on something that was a much higher value. So again, not only is there a timing issue, but there's a valuation issue as well, which again, is probably what I've been blabbing about for the past like umpteen minutes. Another big hurdle that we're going to come across when it comes to wealth tax is the compliance cost of it. Now let's talk about the administrative issues with implementing a wealth tax. Who exactly is going to be the one that's going to oversee the compliance of it? Again, remember, the IRS just lost a lot of staff, and they're potentially going to lose even more. Now, they are going to rely more on AI and software to, again, pick up detections and all that, which sounds great. But again, whenever you roll things out, especially from the government, it's never going to be nice. Heck, I've already dealt with a number of IRS notices recently on people that owe taxes that aren't even correct. It's like the IRS is just sending out notices, hey, you owe this, hey, you owe that. And it's not even accurate. So if they can't even get, basic notices out accurately, how on earth are they going to value assets and do that accurately? Now, time will tell, obviously, but again, I feel like we need to have some consistency and some success in order to, have more faith before, rolling out something like that. So if we can't rely on the IRS to be, in charge of the administrative compliance, maybe that's going to fall on us as the tax practitioners. Well, the problem is that CPAs are in dire need. More are retiring and passing away than they are coming into the field. But and that's just a supply issue. If we look at the demand issue, not only is tax compliance becoming more rigorous, there's more due diligence and so forth. So not only do we have less people, but the demand for work is increasing. So that's a double whammy right in itself. So if we're going to be expected to do more compliance when it comes to asset valuations and whatnot, not only will CPAs probably get more burned out quicker, but the pricing of our services are just going to skyrocket. Now, keep in mind, when it comes to compliance, whenever we're talking about ultra, wealthy individuals, the issue of valuation is already there in the vast majority of cases. I can't tell you a percentage, but I think it is the majority. So if we take wealth into consideration as well, the topic of asset valuation issues is going to be even further expanded, which is going to lead to a situation where the cost of compliance, the cost of actually enforcing this, is probably going to be more than the revenue that we could potentially generate. And if that's the case, it doesn't make any sense. You don't spend $100 in order to receive 80. No. So the only way to really avoid that is to have a proper wealth tax that's actually going to bring in more income than what the cost of compliance is going to be. Now, what is the cost of compliance? I don't know. It's probably going to be pretty substantial. So again, we got to make sure we have a high wealth tax in order to compensate for that. But then that leads to the next issue. Having a ultra high wealth tax is going to lead to more, again, wealth mobility. You see, wealth is mobile. I can move assets and art and collectibles and all that to different areas. So again, if I'm a US resident, but I have all of my wealth in another country, who actually pays tax on that? Is it the country that has the asset, or is it the country of residency? Well, if it's the country of residency, then what's going to stop me from renouncing my residency and picking up citizenship somewhere else? Case in point, Eduardo Saverin. If you don't know who that is, co-founder of Facebook, who made a bunch of money and wealth exploded right before the IPO. Now, granted, he could have paid a bunch of capital gains tax here in the US, but he announced his citizenship and went somewhere else. I think Singapore, maybe. Now, he claims his move had nothing to do with saving taxes, but the timing of it just seems a little suspicious. But again, if we are going to implement more and more wealth tax and whatnot, it's going to be much easier and much more prominent that people are going to shift, again, residency and citizenship and assets offshore in order to avoid taxes. And since wealth is mobile and people can move it and avoid taxes, that is going to lead to an issue of discouraging investments and entrepreneurship. Another case in point is France. See, France even had a wealth tax for a number of years. And relatively recently, probably within the past, I think 10 years, I don't know, I'm not an expert in French taxes. They had a wealth tax, but they actually had to repeal it because what was happening was more and more millionaires, people who were considered wealthy and that reached this threshold, moved out of the country. There was a decrease in, again, investments and entrepreneurship, and again, less tax revenue to obtain because, again, people were moving. So in the end, not only France, but Germany had a wealth tax as well, and both of them repealed it because, again, they received less than expected income from those wealth taxes. Because at that point, the cost of, again, enforcements and compliance and whatnot was not greater than what they were receiving. So again, from a cost-benefit analysis, it didn't make any sense. Now, coming to this side of the Atlantic, let's talk about potential wealth tax here in the US. So you see, Elizabeth Warren actually proposed a wealth tax a while back that was, again, some percentage over a specific wealth amount or whatever. Again, I think it was on the top like 50 million or something. I can't tell you off the top of my head. I don't have it in front of me. But it was projected to raise trillions of dollars. I think between 2 or 3 trillion over the course of 5 or 10 years, which on paper sounded great. But even just like looking through the paperwork, when I remember trying to go through it and just kind of understand it better, there really was no contingency on people leaving. So again, in an ideal world, yes, we would have gotten 10 trillion over the course of whatever the time span was. So her proposal made sense from that standpoint. Once you get into the actual reality of it, again, people are going to move. There's going to be avoidance strategies in order to, again, avoid higher taxes. People are going to move. There's going to be arbitrary asset valuations that's going to lead to lower wealth. So that 3 trillion may be a huge stretch. So in the end, could a true wealth tax work? It could. It's going to be very tricky to implement. It's going to be very costly to comply with. It's going to be, again, everything that I've been blabbering about for the past, however long this has been. Again, it's not going to be easy. Now, a more probably direct way of doing a wealth tax is to, modify it and tax what is known as unrealized capital gains. So for example, let's say you have $100,000 in your retirement account. That's January, and at the end of December, you have $130,000 in that same retirement account. You didn't put anything in, so that $30,000 of growth was from, again, stock appreciation. But if you don't sell that stock, there's no income. So again, in this instance, you don't pay income tax. So again, you started with $100,000, you ended at $130,000. That $30,000 is not considered income because again, you didn't sell it, but it is considered an unrealized gain. So in current income tax law, if you were to sell, again, 130,000, all 130, that 30,000 would be considered capital gains. So an unrealized capital gains is gains that are unrealized, or AKA not sold. So in this case, you start with 100,000, you ended the year with 130,000. In our current U.S. tax system, you would not pay any type of income tax until you actually sold it. At that point, that 30,000 would be considered capital gains tax. But if we were to tax unrealized capital gains, again, you start with 100,000, you ended at 130, that $30,000 of growth would be appreciated and that we would pay tax on. So it's kind of a quasi wealth tax. Now, whether we actually tax unrealized gains at this low of amount, if we have to be in the millions or whatnot, again, that's a whole nother story. Should we do 50 million? Should we do 100 million cutoff? Again, that's beyond the scope of this video. But again, maybe that's going to have to be what we actually do in order to, again, implement any type of wealth tax in this country, because a true wealth tax, like I just talked about for this video, is going to be very difficult. But in the end, an unrealized, again, we're going to have this sort of the same issues that we've had before, but it's a little bit more straightforward because, again, from an unrealized perspective, you're still on like an income basis, right? You have a starting period and an ending period. You have X dollars at January. You have probably X plus Y at the end of the year. So that appreciation, Y, is unrealized gains. You kind of look at it in a sense of income rather than wealth, which again is at a point in time. Because the whole issue with looking at wealth as of a specific day means that we have blinders on. We can't see what happened before. We can't really see, how it affected afterwards, because you're only assessing tax on a specific day. So in the end, if we are going to implement a true wealth tax, a tax on net worth at a point in time, well, ultimately we're going to be putting a lot of faith in the IRS. So again, just take that however you want.